I'm going to explain how banks make money and then how other people make money to the point that it degenerates into people selling nothing to each other, but still making money, because the best way to make money is by selling air. In the center, we've got the bank. On the side, we've got yourself. And you have a desire to buy a car, but you don't have the money to buy that car. You could get the money by asking the bank for a loan. So the bank is going to loan you the money to get your car. You're getting a nice car. Yeah. Not something that Musk made himself in the basement, like a proper one. Yeah. You're getting a loan, £50,000 to buy the car. Let's assume it's simple because it's a little bit more complicated, but let's assume it's like this. The bank gives you the money. You give the money to the car dealership. They give you the car. And then you make repayments back to the bank slowly for a period of 5, 10 years, 15 years, depending on what your agreement is. And that has a cost because you pay interest rate on those repayments. So presumably you got the car for £50,000, but when you come to the end of your term, you're going to repay back the principal amount, which is the £50,000, and you're going to have to pay back the interest. So let's say that you end up repaying a total value of £60,000. That's why it's a great idea if you get 0% finance, because you can stretch the repayments. It allows you to get the car straight away, and you don't actually have to pay anything extra. If anything, because of inflation, and that's why this is a great deal, and that's why you should always get a loan if the interest rates are low, because if the interest rate is less than inflation, the value of this degrades. You're going to end up actually repaying less if you got it on 0% finance. Now, on the other hand, I'm sorry to break the news to you, but your car will lose in value way quicker than inflation is going to eat away at the money. But, it's a choice that you make when you're buying a new car. Yeah. Okay, so that's phase one of the deal, how the bank gave you the money for you to buy the car and how you repay the money. So the bank will make money by the interest that it receives on your loan. Do you think the bank is going to be happy with that? Maybe, maybe not. It's not just you. Yeah? The bank is making a whole bunch of loans. So there are many people buying cars, not just yourself, right? The bank has made a significant amount of loans to these people that are doing the same thing. The bank now has to wait. So again, this is a play between time and money. So the bank needs to wait for all these repayments to trickle in. Eventually, the bank is going to make a profit on this as people are repaying back the principal amount and then repaying the interest. So in the end, the bank wins, but it takes a significant amount of time. That's not how you become rich. You don't become rich by waiting. You become rich by using the financial markets to accelerate your cash flows. So what the bank will do, the bank will attempt to package all these together and create a financial product which they can then sell to somebody else for money right now. And they can accelerate the cash flow directly into their accounts instead of waiting for the 10 years it's going to take all these people to repay the car loans. Now, question is, the bank created this financial package here and has sold it to somebody else. How does the person who bought the package make money? I mean, I understand how the bank makes money, but how does the purchaser of the package make money? So why would I, if the bank came to me and said, look, I've got all these bank loans. Woohoo! Would you like this income stream? So you end up with £60,000 times X in 10 years. Why would I think it's a great idea? They don't buy it for the total price, right? So if the bank has an incoming flow of 60,000 per loan, when they're selling it to somebody, they need to give people an incentive to buy it. So they're not going to say if we got 10 of these, right? We've got 10 car loans. So the total value at the point of repayment, 10 years down the line, is going to be 600,000. They're not going to sell the package that they put together for 600,000 because then people couldn't make any money. They're going to sell it for 500,000 or less. Each car is worth 50,000. What the bank will get eventually after 10 years is 60,000. The bank doesn't want to wait 10 years because they need the money to do something else. They want to put the money into more loans, accelerate their growth, and so on. Maybe they accept to sell it for 55 each. So instead of waiting 10 years to collect 60, they're selling it today for 55. They get that money in the pocket right away. They made a little bit of a profit, and they don't have to run the risk of any of these people defaulting on their loans. So it looks like a good deal for the bank. These guys here that are buying the package, they're getting it at a discount. So they know that if they sit it out, they're going to make the 600,000 at the end. So they made a 50,000 profit for doing nothing. And remember, this is interesting because these guys here are doing nothing. The only thing they're doing is assuming the risk. They don't have to negotiate with the car dealership. They don't have to negotiate with the people. Don't have to go all the hassle of verifying the customers and all of that business. The only thing they do is get the money, give the money to purchase these things and then sit. It could be that then you find somebody else to sell it. And that's why this becomes such a dynamic, interesting thing in the market. Everybody makes money. So, because this is the foundation of the financial system. If we haven't understood all this, then we're really not getting anywhere because there's no point in talking about the details of the rules if we don't understand the mechanics. This is called a number of things, but at its base, it is called receivables financing. Why receivables? Because you're receiving something, you're taking something in, and you're using that something to raise money. So you've got an initial obligation that is worth an X amount of money. Then you're passing on that obligation to somebody else at less than the total value. That person then who has it can wait, collect the total value. The originator of the asset wins because they get the money quicker, perhaps not 100% of the value, but they get the money quick. They don't have to bear the risk of anybody defaulting and so on, so they make a profit. The people who bought it, because they bought it at a discount, if they can wait till the end, they make a profit. These guys are happy, these guys are happy. If they find somebody else to sell it within that margin, so if the total value was, say, 600,000, and these guys bought it at 550,000, then at any point that they are between the margin of this and this, as they're selling it on, they could still be making a profit. They could decide to sell it to somebody else. Yeah? There's an immense market that deals with this. All my rich friends, that's what they do all day long, right? Actually, they don't personally do it themselves anymore because they're the bosses, but they've got people working for them that they do it. They're the ones who kind of organize the big deals and organize how the institutions work. This idea works, that you take an incoming stream of money and you sell it to somebody else. And then it's a play between time and value, and everybody down the chain wins. If we're thinking about an incoming stream of money, everything is an incoming stream of money. You pay your phone bill every month. That's an incoming stream of money. Any sort of loan, credit card, student loan, mortgage, everything, right? It's based on contractual obligations that creates a flow of money. All of this can be packaged and traded in a market. You could do it yourselves. I can do it. I do work for people. I issue invoices. The invoices are paid in 30 days. That's what my terms and conditions are. Meaning that from the point that I've done the work till I collect on the value, I have to wait 30 days. What if I don't want to wait 30 days? I could sell my invoices to somebody else to get the money quicker. I'm not going to get 100% of the value, right? Because then there wouldn't be an incentive in anybody buying it. So I'm going to sell all of my invoices at a little bit of a discount. So it could be that I've invoiced people for £5,000 on the 1st of the month, and they're going to be paid on the 1st of December. So I can sell these invoices to somebody else for £4,500 right now. I take that money, put it in my pocket. Why am I doing this? Why am I foregoing £500 of my profit? Because that way I can have the money right now. I can invest it in something else. Maybe I've got another big client coming up and I need the money to finance the next deal, right? I need to buy equipment. I need to do something like this. And I don't have the risk of any of them being delayed in the payment. The person who buys it waits till the 1st of December, collects the £5,000 on those invoices. I am happy. I did what I wanted. I get my money. They're happy. They got their money. They made the profit. Everybody's happy. So it doesn't need to be a financial product at the beginning. It just needs to be an incoming stream of money. Your landlord could sell your rental flow, the incoming flow of money that comes from your rental agreement to somebody else. So it does not need to be anything fancy. The people that buy it, they can do stuff with it. Let's say that the bank who organizes car loans, that's the main thing that it does, and it's got an incoming stream of money for the car loans, and that's what they're happy with. The finance company that will buy the car loans, they will buy some car loans. They will buy some home mortgages. They will buy some student loans. So they could be purchasing packages that contain the car loans. They could be getting the packages that contain the home loans. They could be getting the packages that contain the student mortgages. They can combine those together into a new financial product that contains all of these things and sell this in a market with exactly the same logic as before. This product is priced on the basis of what it contains. So they bought this, say the original obligation was £1,000 for each one. So they bought each one of those at £800. They now repackage it to sell it to somebody else, and they price the whole thing at £2,000 to make it attractive to somebody else to buy it. Yeah? That way, it accelerates the payment flows to everybody. Everybody gets their money quicker, pushes down the risk to somebody else down the chain. Everybody makes money at every step of the way. This is how the bigger financial markets work, and this is how you create what we call derivative products. Why are they derivative products? Because they derive from something else. So in the same way that, you buy potatoes and you make a potato dish and you're selling it to people, that's part of the deal here. These are the base ingredients, and they've been cooked together into different financial products that then they're made available into marketplaces. Now, one of the interesting things about the combination financial products is that it becomes a little bit difficult to work out what exactly is in them. The law here has a significant impact in telling you what information you need to put together to explain what the product contains. Because it isn't just a matter of saying, I created like a basket of items here and it has X percentage of car loans and X percentage of mortgages and X percentage of student loans. It isn't simply the ingredients that you made this cake with. Regulations like the financial markets instruments, directives, and all of that stuff, they will tell you in detail what is the information that needs to be created with the prospectus that you're going to have to give to people that explains the terms and conditions and contents of the product when you're trying to sell it into a marketplace. This is a process that is similar to the selling of shares. If you're trying to list shares in a stock exchange, then you're obligated by law to create a prospectus. The prospectus is basically the leaflet with the terms and conditions that explains what these shares are and what rights they represent, and the mechanism for valuing those shares. What is the company like? What they intend to do? All their financials and all the rest of it. So similar process exists for the creation of this. Everything that gets floated in a marketplace needs to come with this information, be it stock in a stock exchange or a financial asset in a financial market. So there's an immense amount of law that operationalizes the content of this. That's why the lawyers that work with the financiers that are putting together these products are charging so much money, because the regulatory burden is quite significant. So you need to have people with really high levels of expertise and competence to put these things together properly. Because if this is problematic, then it has very serious consequences. But once these things are listed in marketplaces and they're floating in marketplaces, once they're already out there, you need some quick ways for people to figure out whether they want to buy them or not. Of course, the documentation always exists in the background, but people don't necessarily look at this exact documentation. They look at it the first time a product is launched, but once it's circulating into the market, they don't look at it again and again. That's important because once these things are floating in stock markets, then they're sold continuously from one person to the next. It isn't just bilateral transactions here that the originator sells it to one party or then sells to another party and it stays there. These are tradable instruments in markets, in the same way that you can buy shares in a stock exchange at the press of a button, buy it really quickly, and then sell them again at the press of a button. This is what's happening here. So what are the shortcuts that allow you to understand whether this is a good proposition or not? So you get a few key things. You have the price, you got the price of the product, and you have the interest rate that it pays, because all of these, the key element in all of these products is the interest rate that it pays, so you can estimate how much is it worth now to buy and how much is it going to be worth when it matures, considering the level of interest that comes with it. So you got the price, you got the interest, and then you got the credit rating. Because a very significant aspect of all of this is that all of these are incoming streams of money. You don't have them yet. And if some of the people who have these incoming streams of money stop paying, then the stream stops, which is bad for everybody. So you need to be able to have some sort of assessment as to how risky this is. You guys ever defaulted on a loan or missed a credit card payment? Yeah, it happens all the time. People default on their loans, they miss their payments and all that stuff. So in anything that is a flow of money, you need to have some level of assessment as to whether people are going to keep up with it or whether there's a risk that they're going to stop paying. Because it's traded, it's got a price that you can discover at any given moment. The whole point about being in a marketplace is that you get really good mechanisms for discovering the price. You want to buy Tesla shares, you can see how much the Tesla shares are today, right? You want to buy shares in BT, you want to buy shares in Vodafone or whatever is listed in the stock market, you can figure out the price immediately. Financial products have got the same price discovery mechanism. So you can check what level of, what types of financial packages are available for sale today, and you can check the price that they sell. If the product is considered good. It's a safe product. It's got a high credit rating. It's considered to be safe. So the credit rating agencies are going to give it like a triple A, right? It's a very safe, nice product. The majority of the people who are within it are likely to continue to make their payments. If it's a safe product, it doesn't pay a great deal of interest because it's a safe product, it's good. And the price of it tends to be quite high because, again, it's a valuable thing to have. If something changes, so the people in the product, because these are dynamic, right? The pricing and the rating and the interest rate change all the time. If, say, you're the holder of this product and you want to get rid of it because you realized you don't want to wait till it matures to get all the money, you need the money quicker, or you're worried there's something wrong with it. You hear bad news about the economy and you hear bad news about universities and all of that stuff, or bad news about the employment market. And you're thinking, whoa, this thing here contains a great deal of student loans. I'm reading in the press that graduates are having trouble finding jobs because the AI is doing all the graduate jobs. Therefore, if the graduates don't find jobs, they're not going to pay back the student loans. So if they start defaulting on the student loans, then the incoming money flow for this product might be disrupted. So I better get rid of it now so I'm not stuck with a product that's got a high level of default later on. In order to get rid of it, then the product changes to make it more attractive to new buyers. If your price is high and the interest rate is low, then people have got no incentive to buy it. They're not going to make any money, are they? So the price of the product, to make it attractive, will drop and the interest rate will go up. So interest rates and prices always move in opposite directions. You will buy an investment if the interest rate is high. You will buy a product or an asset to hold if the price is low. So the housing market gets in trouble. The houses become cheaper to incentivize people to buy them. Savings accounts, if the banks want to entice more people into savings accounts, they will increase the interest rate so more people invest their money there. So to make things more attractive, price goes down, interest rate goes up. So when the credit rating deteriorates, things become more risky, interest rates up, prices down. This is again a dynamic process. At any given point, there's a whole bunch of people supported by a great deal of IT that looks at all these things in combination all of the time. So when people have got a portfolio of investment, that's what they mean. You've got all your money invested in a whole bunch of stuff. And continuously with that portfolio, you're looking at how the risk is developing in the various products you've got inside, how the prices are developing, and you're looking for opportunities. When the risk increases, you try to sell stuff at the best price you can get. If things are safe, right, then you can wait and collect the money at the end of the day. Or, if the price is high and somebody wants to buy it, you can take the opportunity and sell it there. So this is the sort of dynamic nature of portfolio investments, and there are always people looking at this trying to make money. What is very interesting about all this is that no new thing, no new value has been generated in reality throughout this process. The original value was created here when you got your car. The original real world transaction was at the very beginning, a very long time ago. And this is where real world transactions and wealth and money departs from what's happening in financial markets. You created this obligation that's going to run for 10, 15 years. For the next 10, 15 years, you got a very dynamic set of exchanges happening in financial markets that are continuously making people money all the way through. but the original real world transaction was 10 or 15 years ago. So that is the beauty of the financial system, that it takes incoming streams of money that could be going for a very long time and then puts them into this kind of washing machine that works and washes forever. And at every step of the process, people make money. And they make money by waiting to collect at the end, by selling to somebody for more than that they bought it from, and all of that stuff. In addition, anybody who makes the package collects a fee. When you go and buy a mortgage, you're going to have to pay a fee to the originator of the mortgage. Sometimes the fee is included by the bank. Sometimes the fee is paid by the customer. Because the people who put together the car loan package, they might say, you pay £100, 200, 300 pounds as admin fee to put the package together. So the originator of the loan makes £300. When this gets repackaged by the bank who puts the package together will also collect a fee. When it gets packaged into a bigger set of funds with all the other stuff, then they will collect a fee again. So there are fees all along the way for creating the packages by the finance people. There are always fees that are paid to the lawyers. They have to do all these prospectuses and all this documentation that goes all the time. There are fees for the credit rating agencies that are going to have to look at that stuff at every step of the way to give it a credit rating, so then they can have this kind of marketing material and this information that the market needs in order to be able to operate. There will be fees for the marketplaces that these things are traded, because you need to pay the exchange to have the right to be in the exchange and so on. So this is all a humongous money-making machine for everybody, for the lawyers, for the accountants, for the finance people, for the sales people, for absolutely everybody. And it will keep on going. And, the loans that I told you about have relatively short time frames. Like a car loan is going to be 10, 15 years. A home loan, a student loan is going to be 20. A home loan might be 20, 25, 30 years. You have government bonds that could be going for 50 or 100 years. You have corporate bonds that could be going for 50 or 100 years. So the time frame could be immense. Meaning that the longer the time frame, the longer the opportunity you've got for these markets to work things in and out and to get stuff done.